I want to continue our series here on the OB3, the one big beautiful bill that was signed into law on July 4th, 2025. Because I don't know when you're watching this, but we're recording somewhat contemporaneously. We've already gone through several of the chapters on the tax section, which is Title 7, and we're into Chapter 3, establishing certainty and competitiveness for American job creators. Sounds fancy. Subchapter A, permanent U.S. business tax reform and boosting domestic investments. The thing about all legal documents is that there is this principle where the introductory text is not definitive, and the details are further down into the text. Whenever you read a bill or a law or the Constitution or whatever, the introductory stuff is just giving you the framework, and then we get into the details. When you have things that are vague in general in the introduction, that's not actually a guideline. This gets into the general welfare clause that a lot of people argue with the Constitution, and it's just bad legal theory. However, I'm not a lawyer, and I'm certainly not your lawyer. So we'll just get into the details here. Section 70301. What I've been doing in past videos is going through whole subchapters, but these I want to go into in enough detail that these are all going to be standalones. 70301, full expensing for certain business property. And this is made permanent in general. Section 168K2A is amended by adding and striking quotes at the end of clause 2 and inserting a period and by striking clause 3. So what is section 168 referring to? And that's Title 26 of the U.S. Code, which is the tax title. Section 168 is acres, accelerated cost recovery system. And then in, was it 86? They created makers, which is modified accelerated cost recovery system. The point is, this is how you depreciate property. And you can go into reading the whole thing. There's all different categories. It says here, there's 5-year, 7-year, there's 3-year, some 10-year, then agricultural stuff, 15-year property, 20-year property, then somewhere in here will be the real estate stuff, and on. We get down to 168K2A, if we can find that. I had searched for K, not that K. Here we go. Special allowance for certain properties. Special allowances are special depreciation rules. It's talking about qualified property right here. K2A under section 168. We're modifying clauses and so forth. And they are specifying a couple pieces in the agricultural sector under certain plants planted before January 1st, 2027, and so on. Here's the big thing, 100% expensing. In general, section 168K is amended in paragraph 1A by striking the applicable percentage and inserting 100%. So we go to 168K, paragraph 1A, and the depreciation deduction provided by section 167A for the taxable year in which such property is placed in service shall include an allowance equal to 100% of the adjusted basis of the qualified property. Oh, they've already updated this, which is good. An allowance equal to 100% of the adjusted basis. Adjusted basis is, in most 99% of cases, is just going to be the cost of the thing. What this does is it allows for assets to be 100% depreciated. And for 2025, we have a transition rule here, which is what it's talking about here. And it's talking about how in 2025, under the Tax Cut and Jobs Act, we were set to have a 40% special or bonus depreciation rate. And if for assets that were in the taxable year ending after January 19th, 2025, because January 20th was the inauguration of the new administration, then those are going to apply for 100%. If you bought assets between January 1st and January 19th of 2025, you're still stuck in this 40% window. But if January 20th through December 31st of 25, you get the 100%. And same thing with plants and everything. Plants are funny. We've had some agricultural clients that there's special kind of inventory rules with generally accepted accounting principles, which is GAAP, and how that applies to taxes. It gets weird. Effectively, what section 70301 does is it brings the 100% depreciation back for pretty much all assets, excluding real estate. And even some real estate, there's special categories, which we'll get into another video. And what's the upshot of this? The upshot of this is that it allows for people's spending to be in line with their tax. And if you've never run into this before, if you have a service-based business, you're a consultant, let's say, you don't have a lot of assets, right? It's mostly cash in, cash out, and that's the end of it. But if you have a capital-intensive business where there's property or there's equipment or whatever, you spend $30,000 on a machine, you don't get to, or in the past, you didn't get to write off $30,000, even though you're out the cash, right? You would have to depreciate it over the useful lifetime of that piece of equipment. And if it was a 7-year piece of equipment, you divide 30,000 by 7 years, and each year you would take a chunk. But in the meantime, you're out the cash. In a sense, you are paying higher taxes today than you would have otherwise if you were able to expense that item. And that's very hard for people to get their minds around. The thing that this does is it brings tax deductions in line with cash accounting, mostly. There are some special weird things that happen as you get into financing of equipment and things. And people who are doing that need to know what they're doing for sure. And you need to have good accounting to reconcile the differences between the actual basis, whatever liability you have on it, and cash payments and so forth. Fundamentally, what we're doing is we're saying you bought equipment, you bought a piece of machinery, you bought computers, and then you were able to deduct them as in the same way that you are thinking about them as a new computer costs $1,500. I'm going to expense $1,500, and my taxable income is going to reduce by $1,500. Now, the great thing about this is that if we go back to the subchapter A title, Permanent U.S. Business Tax Reform, bonus depreciation is one of these things that has come in and out over the years. I remember I think it was 2011, we got 100% bonus depreciation out of the blue. And it was in response to the great financial crash. Congress was trying to incentivize more business activity. So here's 100% bonus depreciation. And then it went away in the next year. And then Tax Cut and Jobs Act comes along in 2020 or 2017, and then we get 100% bonus depreciation again. But then it had this step down. It went from 100 to 80 to 60 to 40. This transientness makes it much harder to do business in a regular kind of way. But by making this permanent, that gets rid of that, at least until Congress passes another tax bill. And if you've been around for a while, you'll notice we get one of these every 10 years. So for the next decade, we're probably in this regime where we have permanent, or as permanent as anything is with Congress, bonus depreciation of 100%, which is good, in my opinion, because again, most people are on a cash basis. There are times when accrual, where you book the income and you book the expenses for future agreements into today when you make those agreements rather than as the cash comes in. There are times where that makes sense. And generally, those are going to be for larger, more complicated businesses. For small business, which is the people that I talk to by and large, that is not in the purview. We're in cash accounting, and now our assets are going to be in cash accounting. I'm all in favor of this particular change. I think it could have come a lot earlier from the beginning, would have been great. It is what it is, and we are stuck with whatever Congress actually does. That is Section 70301, full expensing for certain business property, and it's everything less than residential real estate is how it shakes out. That is, if you have questions or if you want to see a comparison of how those different depreciation schedules affect things, let me know. I will note that because there is 100% bonus depreciation and it's allowable, at least in the past, we'll have to see how it shakes out this year, that you can elect to not take the special depreciation, because there are certain situations where I already have a net operating loss. I don't need these depreciation expenses today. I'll preserve them for the future, and I'll do the regular schedule, the 5-year, 7-year. Minority of times, but it does happen. Be aware of those particular choices that you can make, and make sure that you elect the situation that is best for your particular situation. That's it. And we will come back with Section 70302, which is full expensing of domestic research experimental expenditures. That's your R&D expenses, which has been a disaster over the last few years, and this actually fixes it. So I'll catch you later.